Donald Trump shared a tweet on his Truth Social talking about the benefits of medical marijuana. Several weeks previously, he said that there would be an announcement coming out. He said in a matter of weeks, although Trump is kind of classically, he'll say something's happening in weeks and then it doesn't. So hard to say what the actual timing is going to be, but the last data point is we're going to be getting an announcement anytime, because now it has been weeks, anytime on the regulatory changes in cannabis. So what I'm seeing is some really strong potential tailwinds for the cannabis industry. So I'm looking at cannabis companies and companies that are kind of adjacent to directly selling or growing cannabis as well. So the company that I have located is New Lake Capital Partners right here. So the thing to note about New Lake Capital Partners is their share price has mimicked the greater U.S. cannabis market. So if I also look at the MSOS ETF, this is U.S. based cannabis companies. Exchange traded fund that mostly invests in stocks based on a particular theme. The fund is actively managed narrow portfolio of U.S. stocks or swaps related to the domestic cannabis and hemp industry. So if we look at how MSOS is performing and we look at how New Lake Capital is performing, the two charts line up. So New Lake Capital started to go up towards the end of 2024. MSOS started to go up towards the end of 2024, or actually kind of towards the beginning, and then has since gone down. Now, in the last month, or if we look at year to date, MSOS has seen a lot of activity recently. It's up 32%. However, that's going back to here. If we look at this point right here in June, it was $2 per share. So since June, it has more than doubled in share price. And a lot of the reason for that is the dialogue in Washington about rescheduling marijuana. I'm not going to get into the specifics, but just briefly, whenever marijuana gets rescheduled, it's no longer Schedule 1, it becomes Schedule 3, and the tax implications are huge. Companies are taxed currently on their gross their gross income instead of their net income. So they're not able to deduct all their business expenses. For some companies, this means going from not profitable to profitable. For other companies, it means if they're slightly profitable, they may 5x their profits overnight. As soon as marijuana or cannabis becomes Schedule 3, profits get multiplied instantly. Hokage Tilray is my big bag from my naive trading days. It has recovered a little. Yeah, a lot of the cannabis companies have just been suffering. The reason for that is a lot of people were very, very optimistic about the how quickly cannabis would be rescheduled or even legalized. I myself thought it would happen by now. So you're not alone in being naive about the cannabis industry. This has been a wide, it's affected many investors. Many investors thought it would happen quickly. It did not. And then every month that goes by where there's no progress, these companies are hurting from paying tons and tons of taxes. They're not able to get banking. They're not able to have safe banking. It's just lots of trouble for these companies. So a lot of the companies are hurting. Now, New Lake Capital Partners, this is a REIT. So this company owns a portfolio of 33 properties comprised of 15 cultivation facilities and 18 dispensaries that are leased to single tenants on triple net basis. So New Lake Capital Partners is going to make money as long as its tenants are able to pay. Now, if their tenants go out of business, obviously, like if the cannabis industry continues to suffer, then obviously New Lake Capital Partners is also likely to suffer. So they're not 100% insulated from the cannabis industry suffering due to these taxes. However, as long as these companies are able to stay afloat and they're able to continue paying their leases, New Lake Capital Partners is perfectly profitable. So I guess my point here is that even though the overall sentiment of the cannabis industry has been sliding, if we look at New Lake Capital Partners' performance, they have done incredibly well. So starting in 2020, they had 11 $1.66 million in revenue. And that was an increase of 900% on 2019, then 140% increase, then a 60% increase, 5%, 5%. So they've done nothing but increase their revenue. They've done nothing but increase their pre-tax income, going from not profitable to profitable. So they've done nothing but improve their situation. They've grown. However, their stock price continues to fall in line with MSOS, in line with the greater cannabis industry. So this is creating a very, very good opportunity for investors whenever you can find a company that's really being dragged down by the industry, even though its own performance is not so bad. It's actually, I'm about to make the case that it's not bad at all. So first things first, how do we analyze New Lake Capital Partners? They don't have free cash flow. REITs do not have free cash flow. I generally like to use a discounted free cash flow valuation method. So I had to adjust my spreadsheet. So Okaji, I know we talked about you needing a new link. You're going to need another link again because I just upgraded the spreadsheet to be able to value REITs. So REITs, like I said, you can go to the cash flow statement. They have operating cash flow. They have investing cash flow. They have net cash flow. But they do not have, they do not have free cash flow because they're just set up a little bit differently. They don't have the same type of capital expenditures that other companies have. So the substitution for free cash flow in this case is funds from operation or adjusted funds from operations. Okay. So this is the number that I'm using instead of free cash flow. This is how much money they have to return to shareholders. They are required by law to return at least 90% of their profits in the form of a dividend. However, if we look at this company's dividend, let's see, where does it say? Oops, I was looking at statistics. Sorry, dividend. They're currently paying out 135% of their dividend. Now, on the surface, this seems incredibly risky. And by the way, they have a 13% dividend. This is what is really showing that this company is undervalued because their dividend yield is 13%. Now, a company will declare a dividend, right? In this case, New Lake Capital Partners, they have declared a 1.72, I said that weird, a $1.72 dividend every year. Now they divide it up into 4 quarters. Now they declare the dividend, and then the dividend yield is going to fluctuate as their share price goes up and down. New Lake Capital Partners, their share price has just done nothing but go down, even though they have done nothing but increase their dividend. So if let's scroll down to their dividend graph, their dividend has just gone up. So if we go back to January of 2022, their dividend was 31 cents per quarter. Now it's 43 cents per quarter over the past few years. That's an increase of, that's roughly not quite 50%. That's like a 45% increase roughly from January of 2022. So they've increased their dividend and yet their share price has gone down, which means their dividend yield has gone up. Now I digressed a little bit. Back to the payout ratio. So this payout ratio seems incredibly risky. How can they afford to pay out more than their profit? Well, let's dive into that a little bit. So when we look at their revenue, they've got $51 million in revenue, and then they have this big expense right here, depreciation and amortization. Now this is their properties are losing value over time, and the amount that they lose is spread out over a 20 to 30 year period. Now, this is not actually cash leaving the company's hands. This is just the value of their actual assets going down on paper. Now, there will be some concrete expenses associated with their assets. However, it is not the depreciation. This is just accounting losses. So if we go to their actual cash flow, we can see that you start with the net income. They add back in the depreciation and amortization along with other things. They actually have an operating cash flow of $43 million. And if we go to so this is how they're using their cash. So from their operations, they are bringing in $43 million more than they're losing. So they're gaining cash from their operations. If we go to their investing, they invest in real estate assets. This is what brings them additional cash flow in the future. They sometimes sell assets. In this case, they've over the last trailing 12 months, they have not sold any assets, but they have acquired $790,000 worth of assets. And then they have other investing activities where they put some money. That could be certificates of deposit. It could be bonds. I'm not sure what this is. It's a relatively small amount of money. And so then you have your investing cash flow. And then finally, as we go down, you have your net cash flow. But there should be another category here for financing cash flow. So this is their debt. This is their repurchasing of stock and their dividends. So they're able to put $35 million into dividends because they had $43 million in cash flow from their operations. They only spent $5 million on investing, and they had plenty of cash left over to put into dividends. And they spent a little bit of cash repurchasing stock. So that is how this company is able to pay out more than they make in dividends. And that is not uncommon. So let's look at a few other REITs. So here's my stock screener. I'm filtering by the sector of real estate, filtering by market cap and dividend yield. So one of them, I decided to isolate a few of the ones that had the highest dividend yield of the largest companies. So you can see what a typical dividend yield looks like. It's, these REITs, they yield anything from 1% to 6%, usually in that range. And so if we go to the first big one that has a decently high dividend yield, 4.63%, SPG, Simon Property Group. I've got them pulled up right here. If I go to their dividends tab, they are paying out 130%. Another one on this list, Realty Income Corp, 5.34% dividend. I see them referenced a lot. They're very, very popular REIT to invest in. If I go to their dividend tab, they are paying out 300% of their profit. So way more than they're making in profit, but a lot of their profit is reduced by non-cash expenses for tax purposes. It reduces their taxes to claim depreciation. The next company I wanted to just showcase quickly, if we scroll down, here's one that has over 5%. VICI Properties, I don't know if that's Vici Properties, but another relatively high dividend. We go to their dividends tab. Now they actually have a dividend payout ratio of less than their income. Now, older companies that have been around a long time, if they've been able to depreciate out a lot of their assets, then they're no longer able to continue depreciating assets. They're no longer able to reduce their income and reduce their taxes. So at a certain point, there will be companies that have lower payout ratios. And to be clear, a lower payout ratio, like all things being equal, a lower payout ratio is safer. So if you are very concerned about receiving that dividend, yes, it is safer to have a lower payout ratio. Now, this company, it may have other things going on that make it more risky than, say, New Lake Capital Partners. Even though New Lake Capital pays out a greater percentage, the payout ratio isn't the only factor. Now, I haven't looked into VICI Properties, so I can't comment on that. I just wanted to show a few examples of what different payout ratios you might see that are standard in the REIT sector. So back to New Lake Capital Partners. The dividend ratio here is insane. 13, basically a 13% dividend. So if I can establish that this company is just undervalued, it may have some risk because it's in a risky sector, but it seems on the surface to be incredibly undervalued. Now, I like to check that by doing a valuation calculation. Now, earlier I said I like to do discounted future free cash flow. In this case, I'm going to be doing a discounted adjusted funds from operations. So in order to do that, I made some changes on the spreadsheet. So I've got New Lake Capital Partners in there. I made the adjustments. Normally, it shows a percentage here for past free cash flow margin, but we're not using it in this case. We are using adjusted funds from operation. New Lake Capital Partners does not have analyst projections for future revenue. So let me go to that really quick. Normally, I'll use Realty Income Corp. Normally, I go to the forecast tab and I look at the analyst projections for future revenue, and then I use those projections to model future growth scenarios. I'll have a high, average, and low growth, so I can see like a range of share prices that I could reasonably expect. a range of intrinsic values. Now, New Lake Capital Partners, this is a small company, small cap company. It is not traded on the major exchanges. This is an OTC market stock, which means it's traded over the counter. So you cannot purchase this stock with every single brokerage. Like for instance, Robinhood, can't purchase it. M1 Finance, that's the app that I'm using for my public YouTube portfolio for this series. I cannot purchase it sadly on my public YouTube portfolio, but I am purchasing this stock personally with my non-public portfolio on Charles Schwab. And so we'll look at a few different ways that you can purchase this stock if you're interested. But I'm getting ahead of myself. Let's get back to the case here. So there is no forecast tab. So I'm not able to forecast New Lake Capital Partners future revenues based on analysts. However, I can make my own prediction here. And so how do I do that? Let's quickly go to their most recent quarterly report. And if I scroll down a bit, right here. So this is their contractual minimum rent that they're going to be receiving over the next 5 years. So in 2026, the minimum rent that they would receive is $50 million. In 2027, $51 million. So I have their minimum contractual rent obligations that I can factor in. Now, if I look at if I go to New Lake Capital, I look at their financials, I can see that they're already surpassing for the trailing 12 months, they're ahead in terms of their minimum contractual rent. So how can that be? Well, they factor in a 2 to 3% increase in their rent every year. And where does it say that? Let's see, let me go to their real estate section here. I think I went too far. Bear with me. Okay. Well, I thought I had it pulled up. Okay, here we go. The company's tenants operate in the cannabis industry. All of the company's leases generally contain annual increases in rent, typically between 2 to 3%. So for my purposes, I'm going to assume a 2% increase in revenue. That's what I have right here. So 2% annual revenue growth over years 1 through 5, 2% for years 6 through 10, and then a perpetual growth rate of 2%. Now with that 2% revenue growth, if they're able to maintain their past adjusted funds from operation margin, let me dive into that really quick. So we're just 100% clear on what's going on. So their total revenue was $51 million. Their adjusted funds for operation right here, $43.69 million. That percentage is shown right here. This is this payout ratio. The FFO payout ratio measures the percentage of funds from operations paid out as dividends to shareholders. Oh, sorry, I actually misspoke. This is the percentage of the funds that get paid out as dividends. So earlier we were looking at the payout ratio being over 100%. That was over 100% of their profits. But if we look at a percentage of their funds from operations, they're paying out 83%. So my apologies. The way I calculate the adjusted funds from operations margin is I take this number 43 and I divide it by, or I take that number over their total revenue and I get a percentage. So that is the percentage of revenue that they're able to generate funds from operations. The funds from operations does two things for me as an investor. They use that money to pay me as a dividend, and then they also use that cash to expand their operations. They might invest in other pieces of real estate, whether those are dispensaries or growing operations, in order to bring on new tenants and bring in more cash flow in the future. So this is the money that I care about right here, this adjusted funds from operation. This is my return as a shareholder. Even though they might not send me all of it as a dividend, that money is also getting put to good use, whether that's share buybacks or, like I said, growing their operations, which will bring me more dividends in the future. So I'm using that percentage to calculate their future revenues or their future adjusted funds from operation based on a revenue growth, which is right here, 2%. So just a 2% revenue growth means that their fair share price today is $34 per share, which represents a 159% upside. 159% upside. So if we go to New Lake Capital's current share price, the current share price is $13 per share. So if I'm just assuming that they continue on their same level of profitability and they increase their revenue, they don't bring on any new tenants, they just keep their current tenants, which not going to happen. They're going to bring on new tenants. But if they don't, and they just keep their current tenants and they continue with a 2% increase from inflation, then the fair share price is $34 per share. So we're seeing not only a massive capital gains upside, also a 13% dividend while we wait. So, and I think I've talked a little bit about this. What would it take for New Lake Capital Partners to see some capital gains? What is going to bring them up into this $30 range again? They are tied to the cannabis market. They're tied to the sentiment in the cannabis market. They're also on the OTC. So if some regulation changes happen, that's a big if. So if some regulation changes happen, the first one being cannabis is moved to Schedule 3. The second one being safer banking, allowing banks that operate across many different states, operate nationwide. Nationwide banks are not currently able to do business with cannabis touching companies because it's currently Schedule 1. The only banks that can do business with these companies are state isolated banks, like banks that only do business in the state where cannabis is legal, either medically or recreationally. So if we see safe banking, if we see Schedule 3, and if we see the ability for major stock exchanges to bring on cannabis companies. Those are the three main catalysts. Each one is a domino. Each one would result in the cannabis sector sentiment improving, which would result in the share price going up. So until those three things happen, New Lake Capital Partners is not likely to trade based on its business strength. It's going to be just tied to the cannabis sector's sentiment. Now, because it is in the cannabis sector, there is some inherent risk there. So it is underpriced for a good reason. I would say that it's way too underpriced. There is a massive upside here with this company, a massive capital gains upside, and there is a huge dividend that I can get paid just while I'm waiting. So I wanted to see a few different scenarios. So this is where I normally plug in the analyst expectations for revenue growth. So I decided for the low, I wanted to see what does it look like if they are shrinking by 3% every year for the next 5 years. I want to see what it looks like if they're increasing their revenue by 5% and if they increase their revenue by 10%. Somewhere in this range is going to be way more likely because all of their tenants, they're increasing their rent by 2 to 3% every year anyway. And then if they bring on new tenants, that's going to represent a larger increase to their revenue growth. And we can see that if we go to their past revenue growth, from 2022 to 2023, they had a 5% growth. From 23 to 24, they had a 6%. And now from 24 over the trailing 12 months, which isn't the full year for 2025, they've had a 3.3% growth rate in their revenue. So this scenario seems far more likely. But let's look at the worst case scenario really quick. Or maybe not the worst case scenario, but let's look at a bad scenario. Let's say they just are hemorrhaging revenue. They're just going to be losing revenue over the next 5 years. The only way that would happen is if they start losing tenants. Their remaining tenants will continue to pay more every year, but if they're losing a chunk of tenants every year, then their revenues could go down. So that's for years 1 through 5. If I mirror that in years 6 through 10, and then we assume after 10 years, the industry starts to turn around and then their perpetual growth rate going forward is 2%, then that would give me a fair share price of 23. So even if in that horrible scenario where they're just losing revenue, their share price is still undervalued. So my question is, how is the market valuing this company? What do I have to put in here as far as their revenue drop for them to be fairly valued? If I assume a 10% drop in revenue over the next 5 years, and a 10% drop in revenue over years 6 through 10, and then a perpetual growth rate of 1%. No, sorry. 0%? Okay, here we go. So losing 10% revenue every year for the next 10 years, and then they never grow again, that puts their share price about $13. So that's a 2% downside. So they're basically, this is what the market thinks is going to happen. They're just going to fail. That's what the market believes. If they don't fail, then this company will make money. That's what it looks like to me. That's what I'm seeing based on running these numbers. So, like I said, a far more likely scenario, and I would say they're very likely to exceed this scenario, is that they don't lose any tenants on average. Like if they lose a tenant, they bring a new tenant on, and they continue to increase rent by 2%. If that is the case, which is incredibly conservative in my mind, then their fair share price today is $34 per share, which is just it's a massive, massive upside. And then if we look at the upper case scenario where we see 10% revenue growth over the next 5 years, maybe we'll see 5% revenue growth over years 6 through 10, and then if they just increase with inflation, then now I'm looking at a fair share price today of $59, representing a 350% potential capital gain. So I love this company, huge potential upside, massive dividend. So that's what I'm seeing in terms of things that I like. Now let's talk a little bit about some of the risks for this company. So this company is not without its risks. If we go to, let's see, I need to refresh this, I guess. Here's their investor PowerPoint most recently. So here's their, they've got 34 properties, 79% dividend growth since their IPO. They have very little expenses, 79% adjusted funds from operation payout ratio. That means they're paying out just 79% of what they could. So they have a little buffer there. They've collected 97% of their rent. So they have not collected 100% of their rent. So they do have a little bit of a black eye here. And that's what I want to look at. So what stopped them from getting 100%? Let's see. Oh, and here, this actually talks a little bit about the catalysts that they see from all three branches of government. So the DEA has already proposed to reschedule cannabis from Schedule 1 to Schedule 3. President Trump has stated support for Schedule 3, as well as adult use and legislation focused on industry reform. Another big one is safer banking, which is also supported by President Trump, creates easier banking access for operators. Also, the federal circuit courts rule restrictions on gun rights for state legal cannabis consumers unconstitutional. This was something that came up lately, or I should say recently. The federal court struck it down, so that was dodged a bullet, you could say. No pun intended, or well, kind of intended. Yeah, so just a little bit about that. Also, while we're here, they are diversified by state. They're in many different states. They have many different tenants, Curaleaf being their biggest, who has a pretty strong operation. However, and here's how they structure their deals. So 100% triple net leases. What that means is the tenants have to cover their property taxes. They have to cover all of their utility costs. All costs go into the tenant. So that takes a lot of the risk off the table for New Lake Capital Partners. It also allows them to have a very lean operation because the tenant has to handle all of their own expenses, everything. Now, this does mean that the tenants get a lower payment. So that's why they've accepted these terms. Is if New Lake Capital Partners was going to cover the risk of property taxes, because property taxes could go up and down, or insurance could go up and down. If New Lake Capital Partners was going to take on that risk, then they would be able to charge a higher rent fee. But they have substituted lower risk for a little bit of a lower fee. Now, I'm fine with that. I'm actually really happy with that. The fact that they've taken on a lot lower risk, because they're still underpriced. They're still paying a huge percentage dividend, even though they have the triple net lease agreement. 15 to 20 year lease terms. Okay, so let's keep moving on. I hope it's in here. It actually may be in this one. Let's actually look in their 10Q. I believe I saw it here, actually. My bad. Alrighty. Revolutionary Clinics. Revolutionary Clinics faced operational challenges. They're out of business. So for the first 2 quarters, they were only able to pay 50% of their contractual rent. So this company right here represents, I believe, 5% of the rent that comes in for New Lake Capital Partners. Actually, I know that one is in this deal here. Give me 1 second. Revolutionary Clinics, they represent 5.6% of the annualized rent. They were only able to pay half of that. So that is where the 97% comes from. So we already had one of these tenants bite the dust, right? So this company is not without its risk. They could lose tenants. Their revenue might be flat. Their revenue might go down a little bit. Why did Revolutionary Clinics go out of business? So this company, I hope y'all can see that well enough. The downturn of Rev Clinics illustrates a broader industry struggles in Massachusetts, particularly the oversaturation and sharp decline in cannabis prices. Also, it looked like a little bit of mismanagement. They expanded very rapidly. They took on a lot of debt. They had major debt payments, interest payments. And then when you couple that with the what am I trying to say, margin tightening, then you have a problem. So Massachusetts having issues. I decided to ask ChatGPT, are there other states that are having the same risk? The answer is yes. Michigan, Colorado, Oregon, California, Arizona, Nevada, Oklahoma. These are the ones that have big price compression risks according to ChatGPT. And if I look at where does this company have the bulk of its rent coming from, let's see. I know they have that information in here. Where is it? Bear with me. Okay. So by percentage here, the percentage of rental income. These are their 5 largest. Here we see Massachusetts at 11%. This is in a state that is at risk. Now, what's going to happen with their lease is Revolutionary Clinics is going to go out of business. Some other operator is going to move in and take over that operation. And so most likely, it's not going to represent a long-term loss on the total rent that New Lake Capital Partners could be bringing in. However, it is an at-risk state. Now, fortunately, none of these other states are on that list according to ChatGPT, and that is the bulk of their revenue. So 26 plus 19, that's 45%, plus 20, that's 65%, plus 9, that is 74% roughly of their rental income is coming from these states, which are not a huge risk. I hope I did the math right. It's going to be embarrassing if that was caught on camera. So there's some risks. However, there's also a lot to like here. Now, the cannabis industry in general is growing quite rapidly. If I look at the projections on Fortune Business Insights, the global cannabis market size was valued at $43.72 billion in 2022. It's projected to be 444 by 2030, which is a compound annual growth rate of 34% per year going into 2030. So there is lots of projected growth in the cannabis industry. We're seeing some hints of tailwinds as far as regulation goes. So in my mind, more likely than not, the cannabis sector is going to be going up in investor sentiment in the U.S. in the coming years. So I think this is a solid investment. I also want to showcase a couple other of those REITs earlier using the same exact assumptions that I did with New Lake Capital Partners. So let's return to the 2% growth. We have our discount rate of 8.29%. This is the percent return that we want every year. So whenever I say, let's go with the average analyst expectation. So if $39 is the fair share price, that means if I buy it at $39 per share, I should expect an 8.29% return every year on my investment through dividends and capital gains, if these assumptions are correct. So next, let's see, with these same assumptions, using the the margin, the adjusted funds from operation margin, the same margin calculation that I use with this company. Let's see how, let's go back through the list. Simon Property Group, that was one of them that we looked at. Simon Property Group, 7% dividend growth, really strong. 4.63% dividend yield, solid yield. Ticker SPG. Let's see where these guys come in. SPG. So given those same assumptions, only 2% growth, this company is projected to have a 25% downside. So a company like SPG is going to need much higher revenue growth for it to be fairly valued. So this is showing you what companies typically look like when you assume bare minimum revenue growth. This company is overpriced if that's the case. Their 22% upside is only coming into play because of this high revenue projection of 10%. So, and if I go to Simon Property Group and I look at their forecast page, we can see that they're probably projected to be about 10% revenue growth. Let's see. So yeah, the upper end is 7, 16, 10%, 6%, 8%. The average analyst is projecting much less than that. So Simon Property Group, using this valuation criteria, is a little bit overvalued. Let's do the same thing with Vici, and we'll also do it with Realty Income Corp. So Realty Income Corp is O, that's their ticker. So given the same exact assumptions, we have a 43% downside, fair share price of 34 with those same assumptions. With Vici, once again, overvalued with these assumptions. And so I think that really absolutely demonstrates how undervalued New Lake Capital Partners is, because I'm using the same exact New Lake Capital Partners. Same exact assumptions. And now we're seeing massive upsides. So yeah, I think New Lake Capital Partners is in a great position. Huge dividend while I wait. I'm just going to be reinvesting the dividend into new shares. And then eventually, who knows when, really who knows if. Like, I can't tell you for sure that we're going to see regulatory change. What I can say is that the DEA has already approved it. The HHS, Health and Human Services Department, has already backed it. The Office of Legal Counsel says there's no problems with it. Trump has backed it. All signs are pointing to Schedule 3 happens, which is going to be a huge, huge tailwind for the cannabis industry, which I think we would likely see some pretty large share price gains in New Lake Capital Partners, as well as MSOS US Cannabis ETF. Now, if you can't, and I was also going to show how we can invest in this company. So if I scroll to the very bottom, well, I thought it was in here. I could have sworn they had a page for how to invest. Damn. Am I crazy? Oh, I looked right over it. How to buy our stock. So E-Trade, Charles Schwab, Interactive Brokers, StoneX, Roth Capital, Fidelity, Ameriprise, Wells Fargo Advisors. There are lots of ways that you can have access to New Lake Capital Partners. I personally have a Charles Schwab account, so that is where I buy this company. So just be aware that since it is trading over the counter, it's not available on all brokerages. Okay, so that is the main company that I wanted to look at during this live stream. Hokage, if you're still there, if you have any companies that you want me to look at, I'm happy to do that right now. This is the time where I take suggestions from the chat to see, is there anything that you think might be a good investment? Tommy Shelby, what's up? How are we doing today? I'm doing really well. Hokage, I hope you're doing well. Tommy, I'm not sure what you saw from the stream, but New Lake Capital Partners is a cannabis real estate investment trust. They lease to cannabis companies, legal U.S. cannabis companies. So they're not in every state. They're just in the states where cannabis is already legal. They've got 33 different properties, or 34 now, 34 different properties, diversified across many different states. So right here, this image shows the different states that they are currently in and the number of operators, number of tenants. super undervalued company. Undervalued because there is some risk. I'm not gonna lie, there's definitely some risk with the cannabis industry, but I think in this case, worth the risk. So while I'm waiting for any viewers to suggest a company to look at, I do have one company that I want to bring up while we wait. Okay. Oh, actually, I also need to go over my portfolio really quick. Okage, do you think New Lake Capital Partners can pivot and diversify their lease clients? You know, can they? I think they probably can. From what I've seen from them, what I've read, and the interviews that I've seen from their owner, founder, CEO guy, it does not look like that's in the cards. It seems like their niche is cannabis companies, and so it's been profitable for them because it's a risky industry. People don't want to touch it, so that gives them a competitive advantage. In the future, after cannabis is no longer considered risky, after, oh, I missed a comment. I'm not seeing it. Anyway, I don't think they're going to pivot personally. Can they? I think, yeah, they probably can. But I'm not sure that that's in their best interest. I think the reason they are able to be so profitable now and have such a low share price and, sorry, I lost my train of thought, and have favorable terms with their clients, their lessees, is because there's not many people who are willing to do business with cannabis companies. So these guys have the expertise. That is their niche. That's their competitive advantage. Oh, it's not showing up for me. That's strange. Okay. Anyway, have you looked into the competitors of CoreWeave? This is Tommy Shelby, like Fluid Stack, Crusoe, Lambda. Excited to look in that space. No, I have not looked into their competitors yet. I love CoreWeave, by the way, and I was pulling up my portfolio. I invested in CoreWeave, and I think they are great. I'm currently up a bit on CoreWeave. So this is the YouTube portfolio. $5,177 in there. Doing pretty good. We're halfway to 10K. Right now we're on the journey to 10K, investing $100 per week. If we can get to 10K, we might up it to $200 per week, maybe. But the portfolio is doing really well. Let's filter these by most gains to least gains. And we can see, let's go down to CoreWeave. CoreWeave is currently up 16% since we invested. So I'm pretty happy with CoreWeave so far. But yeah, no, I think we could look into a few of those companies, Tommy, today. Not sure if they're public. Okay, yeah, I guess that would help. Okay. Good find on NLCP. I know you have some other tickers bought in Charles Schwab. How do you determine your return when it's in two separate accounts? So, unfortunately, these companies that I have invested in, Charles Schwab, they're both cannabis companies. And I think I also had a gold company. So those companies are not, sadly, I'm not factoring those in currently with my YouTube portfolio. Maybe I will build an Excel spreadsheet so I can show my entire return. But right now it's just so convenient to have everything on one portfolio. But at the same time, like when I'm really excited about a company, I don't want to just not share it just because I can't actually invest in it in my YouTube public portfolio. So this week I'll be doubling down on a company, which I'll talk about shortly. But yeah, I mean, good question. Maybe I should find a way to show that performance as well with my YouTube portfolio. New ticket find by my friend is LIN, or new ticker, LIN. I will look at that one in a sec. Yes, so I actually did talk about investing in gold. I can't remember off the top of my head what the title of the video was, but essentially we looked at gold mining companies. Gold mining. And I haven't looked at it in a little bit, but if I remember right, that company is up quite a bit. I'll have to pull it up here. Well, let me keep on track here. Maybe I'll pull it up in a little bit. But yeah, I haven't looked. Like I said, I haven't looked at it in a while. I don't know if gold is still in a good place today. Not sure. I don't know if it's still undervalued or not. Gold goes up quite a bit, as you know, when there's a lot of market uncertainty. To me, it does seem like there's a lot of market uncertainty, but it's hard to say. It's hard to say. I would need to do another deep dive, but I'm currently happy with what it's done so far. Okage is saying on AGI, yeah, really, it turned out pretty nice. If we look at a year to date, it's up 90%. Pretty good. Oh, gold bonds. I'm not real familiar with gold bonds, to be honest. Okay, let me look at ticker LIN really quick. Okay, so over the last 5 years, it's been going up nicely. It's actually been public, looks like since late 2018, 2019, gone up 181%. Operates as an industrial gas company in the US, China, Germany, UK, Australia, Mexico, Brazil. Internationally offers atmospheric gases, including oxygen, nitrogen, argon, and rare gases. Interesting. Materials sector. First thing I like to look at is margins. 48. Solid margins. I mean, this company looks pretty good. Maybe we'll throw it in the, let's just do a real quick peek. And we need to put in, to be fair, we need to put in the forecast here. The analysts like it. Oh, the revenue forecast is kind of strange. Looks like they didn't chart it quite right. But here, this is the one I use anyway, so let's take a quick peek. Okay, so it's a strong company and the people like it, and so it looks like it might be a little bit overpriced unless I'm missing something here. Oh, wait, hold on. So the past free cash flow margin is 17. Let me see if I need to adjust that at all. 17 is about right. If I adjust, no, I don't want to adjust that. Looks like 17.74 is about right. We can give it a boost of 1. Am I missing something here? It's not a different currency, is it? That would make a huge difference. Yeah, it's in USD. So without doing a deep dive, Hokage, I would say that it looks to be a little bit overpriced. Just looking at its financials, it looked at first glance like it was a really strong company, like really, really nice margins. The analysts think that it's going to be growing pretty nicely too over the next 5 years, 3 to 10%. So the analysts like it. The analysts think, if I go back to the forecast page, the analysts think it's going to go up in price quite a bit. So, this is just my first look. My first look is that it looks like it's overpriced. The analysts disagree with me, so take that, with a grain of salt. But yeah, maybe worth looking a little bit further into, because the analysts are like, yeah, they're all saying buy. Top analysts. And then if I only look at the top analysts, it looks even better. So yeah, maybe I should look into it a little bit deeper. Okay, I'll take note of LIN to look into a little bit deeper in the future. Right now it looks a little bit overvalued. Let me jump back to the company that I want to double down on. So let's go back to my portfolio really quick. Let's look at the companies that are down. So a lot of companies here that are down that I really like. Crocs, I can't shut up about Crocs. I love this company. I've doubled down on this company more than any other. Akame, down $35. I have 300 invested, so it's down a bit. And Simply Good Foods, down $89. So I have, I invested 300 and it's down $89, 44, down 44%. That's not 44% of the total, but that is taking into account the time value of money. So it's when I invested in it initially, that chunk of money is down a lot. The chunk that I invested recently is not down as much. So it's weighting that first chunk of money I invested more than the rest. Therefore, it's showing down 44%, even though $90 is not 44% of 300. So just so y'all are aware of that. So I'm not going to be doubling down on these anymore for the time being because I want to try to keep the portfolio relatively balanced. But one company that is down since investing, and I just love PayPal, this company right here. Let's look at PayPal really quick. This is the company that I'm going to be doubling down on today. So if I look at let's look year to date. Year to date, it's down 22%. When we go to their financials, they've done nothing but increase their revenue every single year. If I go back 10 years, they've done nothing but increase their revenue. If we look at their profit margins, 16. So their profit margins they're kind of sporadic. They've been as low as 14, as high as 30, 16 right now. Free cash flow margin hovers between 14 and 25, it looks like, maybe 14 to 30. But continuing to grow every single year. Oh, gosh, and I just remembered one thing. Sorry, I got to backtrack a little bit. If I go back to New Lake Capital Partners, we go to their financials, balance sheet. So their total assets, $425 million. Their total liabilities, only $26 million. So very low debt. That means that we have a shareholder equity of $400 million. So as shareholders, that's our equity in the company. When I go to their overview, their market cap is only $270 million. So the value of the shares is like not quite half, but I mean it's much less than the equity that we have in the company. So the price to book ratio is what I'm talking about. Really good price to book ratio on this company. It's insane. Where is it? Price to book 0.68. So 68%. That's so good. Anyway, back to PayPal. Forecast. The analysts are saying probably about 6% revenue growth over the next 5 years. That's what the average analyst is saying. Dang it. Let me get this into the spreadsheet. PayPal is such a good company. PYPL. Okay. Assuming the lowest analyst projections, we're seeing a 50% upside on PayPal. If we assume just 3% revenue growth going forward, 79% upside. If we assume a little bit less than inflation, we say 2% going forward, 50% upside still, 48% upside. Massive upside with this company with just a very conservative outlook. I love it. I love PayPal. When I go to the Buffett supplement, look at the red flags, green flags. I see a bunch of green flags. I don't see any red flags at all. So they also are buying back shares constantly. So I talked about this on a previous video. This is a cannibal company. They are eating their own shares constantly. The more shares they eat, the more their earnings per share goes up because, if I have one slice of the pie and there's 10 slices, I have 10%. If I keep my one slice and then they buy back 5 slices, now I have 20% of the pie. So I went from 10% to 20% because they bought back half the shares. So, they don't even have to increase their earnings over time. They just have to continually buy back shares, and then I have a higher earnings per share. And so that's how this is one way that this company returns tons of value to shareholders, and it is tax efficient. They're not paying a dividend, so I don't have to pay a tax on my dividend. They are just buying back shares. When I go to their cash flow statement, they're getting $6 billion from their operations. They are investing in securities, and they have other investing activities. So This is how they are spending. Oh wait, so this is actually, it looks like they've actually sold. Sorry, they have sold some of their securities. So they invested 10 billion in securities back in 2020, and then they have sold some of. They've been selling it to get cash every year. So sorry, that's not actually them investing. That's them selling some of their securities. So they have 6 billion in positive cash flow from operations, 1.5 billion in positive cash flow from investing, and then in financing. This is where they're spending their cash. They spent 8 billion here. They paid back a lot of debt. They repurchased a lot of stock, and then they had some other financing activities. So $6.5 billion over the last 12 months in stock buybacks. That is how they're spending their cash. So it's a cash flow machine, buying back shares. Love PayPal. I think it's absolutely underpriced. If we assume, like I said, no red flags on the financials, if we assume 2% revenue growth, then we see a 50% upside. It's insane with this company. The market is just very down on PayPal, even though the analysts are saying revenue growth over the next 5 years. That's the average analyst, about 6% revenue growth. The lowest are saying a little bit of revenue contraction, but the truth is probably closest to the average. So PayPal is who I am doubling down on. Thanks for tuning in this week, y'all. Tommy, if you're still around, I appreciate you tuning in. Hokage, thanks again for tuning in. I really appreciate y'all being active and commenting, giving me companies to look at. Tommy, I think it was you that said, yes, I need to look into the competitors of CoreWeave. I'm out of time today, but I'm going to do some homework on those companies because CoreWeave has done really well already, and I think CoreWeave will continue to do well. So anyway, that's all I got. Thanks again, guys. Have a good night, and